Okay guys, welcome back to the channel. Thanks for tuning into today's video. We've got a special video today. We've got Wolves of Crypto here. We're going to be doing a collaborative video talking about Bitcoin, the price action, and actually going through a bunch of community questions today, which will be covering the macro, covering the economy, covering a whole different bunch of trading strategies, and a lot more stuff. So without further ado, we'll go ahead and get into it, but I just want to go ahead and introduce Wolf. Wolf, how you doing, mate?
Not too bad. Yeah, we're ready to get into the charts today. We've got, as you said, a few questions to answer. We're happy to do that for you guys, so let's get into it.
Cool. And Wolf, you're not feeling too well today, how are you? Feeling a bit sick?
Yeah, just so you guys know, I've got a bit of a sore throat, but I'll cope. So if you hear me croaky, that's why.
Cool. All right. Well, we'll get into it. The short term has been quite impressive in the last couple of days. As a matter of fact, we saw quite a significant rally upwards from the breakout of this bull flag, and I've been hearing a lot of talk about, you know, what drove this price movement upwards, and I think a lot of people are kind of linking it to the predicted Fed pivot, because the Fed pivot is becoming more and more likely, and we'll talk about that later in the video. But I think it's catching word on the street. Well, it's catching word now, and a lot of the retail investors are expecting the Fed to pivot, or at least expecting the interest rates to start dropping significantly. And I think that's what's kind of caused this move upwards. But looking from a technical standpoint, looking from a structural standpoint, we still are in this ascending channel. And this ascending channel is this black line over here, and this lower black line. We're kind of bouncing between that level. And we'll come talk about these red and green lines in a second. If you just focus on the black lines first, we can kind of give a bit of an understanding about what's actually occurring. So we broke out of this descending channel over here. We pushed upwards. We had a nice move through this major trigger zone, and that sent us back up to over here. If you remember our video, I think 2 days ago, we were talking about these levels, and we said that the red levels are our major triggers. When we break through red levels, we generally fly up to our next levels. That's exactly what we did, and we caught that trade, made about 320% profit from a long we took down over here. Significant move up there, but let's go ahead and talk about these levels. So if we go ahead and remove everything from the chart, we can get a little bit of an understanding about what we're actually looking at, and then understand kind of how the price is looking in terms of strength. So what we see over here is we see a horizontal channel first and foremost between these two red lines. Then we see a gap, and then we see another resistance zone, and this is another resistance zone. So this is the big resistance zone we'll come back and talk about in a second. Moving down from here, we have our major support. So between our major support, which is our absolute bottom, and our next major resistance zone, which is here, we have this horizontal channel. And we were in this horizontal channel for about 3 weeks. We recently broke up to the upside. So now it poses the question, what do we expect to happen here? Well, we have to go ahead and look at these levels. So now this major resistance has turned into a major support, and this major resistance zone is still a major resistance zone. So what were we expecting? We do not expect a move upwards until this red line is broken and retested as support. Until then, the risk return on shorts are significantly more favorable than they are on longs. If we go ahead and put our stop loss above, you can see we have a 1 to 2 risk reward ratio, and that is assuming the support line holds. Realistically, it could come lower, it could come lower, it could come lower. So right now, your risk return on shorts are more favorable. I wouldn't be looking to overextend into longs on the short time frame. The longs should have already been taken, but that doesn't mean anything when we're taking a look at the macro. When we take a look at the macro later, you'll see that there is a lot of stuff looking really good on the macro, particularly some large macro trend lines have been broken, and I think Wolf wants to talk about that one in a second. But as you can see in the short-term time frame, guys, right now we are anticipating some sort of pullback until this red line is broken. If the red line breaks, we do expect a move to take us back upwards. Where will this move take us? It's very hard to say for sure, but my prediction would be up to this downtrending resistance, which is sitting just under 21,000. We've got the next resistance for the diagonal level.
Yep.
Wolf, I think that's it, man. I think that's all I want to talk about short term. I might just mention that, you know, worst case scenario, we lose these levels, we come back down, we break back into this horizontal range. The trigger for our short, the trigger for our confirmation that we're going back to 17.6, because I know a lot of people are still expecting a retest of 17.6. That's still possible, but the confirmation that will occur, we don't actually get that confirmation until we lose 18,400. So we could come all the way down here and go back up. We could realistically, we could do that. But the confirmation that we retest 17,600, at least the short-term confirmation, is the loss of 18,400. As you can see, this level here is acted as major support. Losing that level will clear that zone and we'll head back down to retest.
Yep, completely agree with that. I'll share my screen because I do want to add a few things there. Now you've got that diagonal line, which is very important. Now this could be seen, depending on how you draw it, it could actually be seen as a descending wedge, but it's not relevant at this point in time. But what I do want to talk about as well, you know, a shorter term, you pretty much nailed it there. And I do want to especially emphasize the fact that longs here are not a smart move. Yes, we have broken, at least on my chart, at least on the Bitstamp chart, I should say, we have broken the downtrending line from November on the daily chart. However, I would argue that one daily close isn't really enough to fully confirm breakout there, especially considering the fact that we have an immediate overhead diagonal resistance as well as the horizontal stuff that you just mentioned. But that is pretty prominent, right? That is pretty prominent. We have broken that downtrending line. Now, look, I said to my community, my followers yesterday that I wouldn't be buying on a daily close above this line. I would, however, be interested in buying if we do break this diagonal line as well. And so that's something to keep an eye on. Sorry, over the next few days. That you certainly should be watching that. Now, look, I've got a lot of things I want to talk about, but I have had a quick squiz at the community questions, and I do think the community questions cover them pretty well. So I don't know if you want to jump straight into that, and that might segue into it.
Yeah, well, I think the community questions kind of cover what we were intending to talk about anyway, so maybe we'll just go ahead and jump into it. I'll go ahead and chuck on the screen share again, just so we can see what these questions are. And actually, that might be the wrong one. Let me go ahead and quickly put on this one. Cool, okay. Can you see my Twitter?
Yeah, it's all good.
Cool, so thanks to everyone who submitted these questions. We had a couple good questions in here. I guess we'll just start from the bottom and go up, because I think as we start going closer to the top, the questions become a little bit more in depth and more detailed. So we'll ask, what crypto/altcoins will you two be accumulating or have looked at for the upcoming cycle? I'm going to go ahead and answer this one first. Real simple. The only cryptocurrency we have accumulated is Bitcoin, and that's been from the June bottom at 18,000. And we had our accumulation zone. Of course, if you're on my VIP channel, you would have bought 18,000. You would have bought the bottom in June, and that accumulation zone extended to about 20,000, depending on your entries. We had lower targets, but that's the only one we're accumulating. We've already said that we're taking longs on altcoins at specific points, and we're going to leave those positions open if the market continues upward, adjusting our stops, and basically turning a short-term swing into a longer-term hold. But we're not actually buying or accumulating per se, intentionally accumulating altcoins right now. We will accumulate altcoins once that bear market resistance breaks, because as I have done a video, and I know Wolf's also done a video on this, we're not going to go into today, but we've both shown you guys how Bitcoin and altcoins move in terms of rate of return over different phases of the cycle. And generally Bitcoin will take the dominance, or Bitcoin will generally gain the most percentage over that first half of the cycle, and only after Bitcoin gets that first drop, altcoins start rallying. So you don't need to feel rushed to buy altcoins at the Bitcoin bottom, because generally altcoins have a lot of room to move, even if you catch altcoins when Bitcoin's gone up like 20 or 30% already. Wolf, what do you think?
I'll expand on that a little bit. In fact, I'll share a chart to expand on it.
Perfect.
Now, look, I strongly disagree with the concept of buying alt terms for long-term holds in any situation, pretty much ever. I mean, other than the very brief period between the halving and the bull market. And again, there's various reasons for this that I'm not going to get into too much, but all you really need to do is understand one main point and then understand two main charts. I'll start with the charts. The first thing you need to understand is that, as you said, with the Bitcoin dominance chart, but actually putting it into real Bitcoin price action, Bitcoin between the bottom and the halving on two historical occasions has moved up 450%. For example, in 2015 and 2016, we're looking at the total cryptocurrency market cap from January 2015 to May 2016. It only moved up around 400% as well. In fact, it moved up around 50% less than Bitcoin. The same thing was the case in 2018. And what this shows is that investing in Bitcoin versus investing in altcoins on a generalized scale between the bottom and the halving is actually going to give you a less return if you choose the altcoin option. On top of this, you're taking a massive risk in choosing altcoins, because unlike Bitcoin, altcoins don't have the proven longevity of Bitcoin. All right, so if you invest in altcoins and you start long-term buying altcoins at the Bitcoin bottom, what you end up seeing is your altcoins might actually die out. And also what you're doing is you're locking up your capital, so that when the prime opportunity to invest in altcoins before the bull run actually occurs, you would have missed out on around 18 months of technological advancements in the altcoin space. It's important to note, guys, and I'll end it off with this. It's important to note that altcoins don't necessarily thrive due to fundamentals. Altcoins are very heavily marketable, right? That's the market. And, you know, me and Whale, myself and Whale, we know this quite well. You know, Warnchain was kind of a big coin for both of us during the bull market. We made a bunch of money on Warnchain. We got 10x eaches on Warnchain. But the point is, that coin should have performed a lot better if it was for the fundamentals. The point is, it didn't have the marketing. That's important to note. So when you're taking long-term investment in altcoins, just understand that fundamentals aren't everything, and you can't predict things with fundamentals. You've got to use that marketing. It's hard to get a good grasp of what the marketing will be like in 18 months when there's a lot of new competition in that altcoin space that's competing with your altcoins. So that's what I'd say to that. I don't think it's a good idea.
I totally agree. And I guess that comes down to the risk tolerance at the end of the day too. It's like, just because statistically and based on the charts we see Bitcoin has a greater rate of return for the first half of that bull market, it doesn't mean you won't find an altcoin that would, you know, triple, quadruple Bitcoin's return. It's just on average, if you take all the altcoins and look at the altcoin total altcoin market cap, it does a lower rate of return than Bitcoin. So it is a gamble in the sense going to altcoins. It really is, can you select the correct one? Can you get it at the right time? Are you going to get a bit lucky? Is the coin that you're going to select going to do well? There's a whole range of factors. And generally, from what we've experienced in the last two bull markets, particularly, the altcoins that do the best aren't the altcoins from last bull market or last cycle. Yeah. They are the new ones. So if you're looking to accumulate an altcoin now, the chances are next cycle, the ones that are going to do 100x, 200x or whatever, are going to be coins that probably aren't even out yet. And that's what we're going to leave that one on there for. Let's go ahead and bring up another question.
Let me just, share the screen. Cool.
Okay, hey guys, US Treasury yields dropped 2 to 3 days in a row. So is this the turn up Bitcoin has been waiting for? Is the market a head fake, or is it a head fake? So is the Treasury yields dropping an indication that the market will turn around, or is it basically a fake out? Wolf, do you have a chart for that one? I'm pretty sure you did, didn't you?
Yes, I do have a bond yields chart. I just need to find it, then I'll share my screen 1 second. Yeah, so is it an indication, 1 second, sorry guys, is it an indication the market will turn around? I think it's more of a result of what's going on with the macro rather than an indication of what's going to go on with the future. But then again, I suppose yields do reflect the future. Look, it's nothing surprising. You know, I think there are questions that will make us get into this a bit more. This is actually the DXY.
Wolf, did you want to share your screen?
Yeah, I'm sharing my screen right now. I think just because you're sharing it as well, it might not be showing up.
Oh, all right, there we go. Okay, go ahead and share. Yep, there we go.
Yeah, so I don't actually have a chart up for it right now. I must have deleted it. But the point is, yeah, this thing's reversing. Cool, and it's not unexpected. The DXY is doing a similar thing. DXY is rejecting from resistance stemming from 2004. So both of these things happen hand in hand, of course. Macro is getting a little bit better. We'll talk about this a bit more in other questions, I'm sure. But you know, one thing I do want to talk about with regards to the macro that it is directly affecting bond yields, of course, is the UN. Now, this is the Wall Street Journal, and this is from 2 days ago. And the UN basically called on the Federal Reserve, as you can see in the title right here, and other central banks in the West to halt interest rate increases, right? There's pressure from the UN, onto central banks. They're saying, hey guys, this is not going well. We need to stop this. And, you know, this is part of a shift back to QE that we're seeing in the UK and possibly, as per what the UN wants here, clearly, what we might be seeing in other Western countries. So, you know, it's no surprise that the DXY is rejecting. It's no surprise bond yields are rejecting. And it's no surprise that you know, the markets are starting to bottom out. And the S&P is a perfect example of that. You know, as soon, I think it was honestly, it might not have been the day, but it might have been 2 days after the UK announced QE. You know, this bounced heavily off of the 200-week SMA, and we're up, what, like 10% or something like that? 7% on the S&P 500. So yeah, it's you know, you referred specifically to bond yields, but it's all part of the big equation, right? It's all just the macro starting to reverse a little bit. That's my opinion on that.
Yeah, sure. I think maybe I'll go ahead and define bond yields, because maybe some people on this channel might not even know the correlation between bond yields and the DXY, because I think the correlation between bond yields and DXY is what we're really talking about here in terms of asset prices. Because if we look at the DXY, we can see the correlation between the DXY and Bitcoin, because the DXY represents the strength of the dollar. We know as the dollar weakens or strengthens, we have alterations in the price of these risk assets. So let me go ahead and actually find a chart. I want to go ahead and screen share. Let me 1 second. I've got so many charts on my computer, it's always a little bit tricky. I just want to go up and move up over here. So I'm going to go ahead and draw a diagram. So if we imagine just a little chart over here, and we have the y-axis, x-axis, and we got bond yields on this side, bond yields over here, and we got bond price over here. There's a bit of an inverted relation. So as bond yields increase, okay, we have this, so as bond yields increase, we have bond prices decrease. So generally a rising yield actually relates to a bullish dollar, and a falling yield equals a bearish dollar. So what we're seeing right now is bond prices decrease. Okay, so we're seeing the bearish dollar, or the dollar losing strength. And if the dollar loses strength, as we've talked about on the DXY, which is over here, we see risk asset prices increase. But what does the DXY really represent? Well, it really represents the strength of the dollar, and it represents the inflow and outflow of cash into fiat, of course, the US dollar, and risk assets. So when the DXY drops, money is flowing back into risk assets, and therefore those asset prices are actually rising. And that's that correlation. So bond yields or bond prices decreasing results in DXY decreasing, obviously results in asset prices increasing. So it is bullish, and it could potentially indicate that upturn or that turning point for Bitcoin, which we'll discuss later on. But just to define a bond, in case people don't know, a bond is essentially an IOU. You know, I lend you money, you give me an IOU. It's like an issued IOU by an entity when it needs to borrow money. So when you own a government bond, because that's kind of what we're talking about, the government has borrowed money from you or from the entity, and essentially that money is paid out at maturity. So the bond could be a 10-year bond, it could be a 5-year bond, or whatever kind of bond we're looking at. And the bond yield, the yield that we're talking about, is a specific rate of return on that bond. And that's kind of the basic definition of those things. But essentially what I'm trying to get at is bond yields, they do serve as indicators for the strength of not only the stock market and the cryptocurrency market, but the dollar and the nation's currency as general. So we can use that to actually kind of correlate that to cryptocurrency and correlate it to the DXY to get an indication of where the prices are going. Okay, let's go on to another one. Did you have anything to add actually there, Wolf, real quickly?
No, that's completely correct. It's all fine.
Okay, so any tips on using low leverage and Bitcoin holding? All right, so you got a couple questions here. For example, I bought Bitcoin at 18,000. Is it feasible to use 2x leverage after halving to maximize my profits? Okay, so if you're gonna buy Bitcoin for a long term, you wanna buy spot. And the reason is because if you're buying leverage, you don't own the coins. You're not buying the coins. If you're on leverage, you don't own the Bitcoin, okay? So it's very important that you understand if you're buying with leverage, you do not own the Bitcoin. So if you wanna buy for long term, your focus should be buy spot, take your Bitcoin, put it on a cold storage. As simple as that. Now, if you wanna swing trade, sure, you can buy a low leverage swing trade. But your question is more about what I'm thinking, gathering from your question is, I bought Bitcoin at 18K. Is it feasible to use 2x leverage after the halving to maximize profits, or is there any other risks? And the risk that you should look at is the fact that, you know, you don't really own the Bitcoin. If you're holding long term, you want to keep it on a cold storage. Obviously, if you're holding on a leverage, you're also going to be paying your funding rates every 8 hours, which is 0.01% or something. You know, so if you're holding for like 6 months at 0.01% a day, you're paying, you know, quite a fair bit of percentage in fees. And that's what I'd really say there. You know, if you want to look at maybe buying, you know, keeping your Bitcoin on spot, and then when you want to enter a leverage position, you can enter a leverage position later. But definitely, if you want a long-term hold, that would be on spot. And I think, Wolf, you would agree.
It's also, you know, aside from the risk of not owning your coins, you know, the exchange could go down, whatever, you might lose your money, and also the fees that go with holding a leverage position. The point is as well, like, you know, liquidation wicks happen all the time, you know, and no exchange is really completely immune to it. I mean, look at Binance last year. There was a wick on Binance during December, during that drop that went down like 4,000 USD lower than all the other exchanges. Like, who's to say you can get liquidated from one of those wicks and it'll be completely out of your control? There's nothing you can do about it. You can't file a lawsuit. What are you going to sue Binance? So, you know, I think leverage for long-term trades is a little bit irrational. I think you're better off just taking shorter-term trades with leverage. That's my opinion.
Yeah, and try not to get greedy, because the whole premise of this statement is you want to make more profit. How can I maximize my profit? And the best way to maximize your profit, essentially, is to focus on the process. Focus on what you can do right now. Focus on your strategies. Focus on your I guess, how you manage your risk, rather than focusing on, oh, I need to make as much money as possible in the bull run. Because the moment you start getting greedy, you're going to hold positions longer than you should. You're going to take a larger amount of capital into positions. You're going to use higher leverage. And all of those things, although they're going to maximize your profit, they're also exposing you to significantly more risk. And if you're not an experienced trader and you don't really know what you're doing, the chances are you're going to lose.
Yeah.
Cool, let's move up. Scott, I answered your question already. That was quite a quick one, but I'll answer it again anyway. How do you determine amount you scale out within a trade if you have 4 take profits that are weighted differently? So the simple answer to that, and this is going to be a really simple one, it is completely subjective based on your risk tolerance. And I can expand on that. And I know you were hoping for a more specific answer, but it really isn't. It really is completely subjective based on your risk tolerance. The more money you take out at specific take profit points, obviously the more profit you're forfeiting, but the lower your risk is if the price downturns again. Because there's no guarantee that a trade will hit all 4 targets. There's no guarantee it will go to the last target or even the second target. So depending on obviously how the technicals are looking, how you've structured your trade, what amount of capital you invested, what your risk tolerance is, what your drawdown percentage is, all of those things will go into determining how much you should be scalping out, or even if you do scalp out. Some people or some trades, you will not even be taking profit at each take profit target. You would simply be moving your stop loss, or simply you won't be doing either. So it's subjective. Wolf, anything to add?
No, it's completely correct, yeah.
Okay, this is quite a longer question, so we'll come back to it as 3 points. That's a long question too. Oh, we may as well just do it. All right, so hello bros. Could you please discuss 2 recent developments? So Bank of England decision to start money printing, RBA pivots and raise rates by 25, and US next to pivot on the 2nd of November. Implications of those decisions, how we prepare ourselves for possible rally. Thanks. Okay, big question. We could theoretically spend 25 minutes talking about this, if not longer. Wolf, do you want to kick it off and then I'll jump in, or do you want me to kick it off?
Yeah, no, I'll kick it off. All right. So essentially, if we want to answer this as quickly as possible, and obviously most effectively as well, because sometimes simple is effective, right? We don't need to, and the average person doesn't need to understand, you know, a 3-hour analysis of macroeconomics to understand what happens with markets in regards to macro. I think that's pretty evident. So his first question was, just read it again, sorry.
So he says, number 1. I guess you can take number 1 and I'll take the next one. So Bank of England decision to start printing money. What do you think about that? What impact do you think it's going to have on the economy, and kind of how you think it's going to impact crypto, because that's what we're here for. So
yeah, sure. Okay, so well, Bank of England, as we said, that last week they went back to quantitative easing, which means they're printing money again. And as Whale explained 5 minutes ago, there, printing money is generally speaking good for risk on assets, which means it's good for Bitcoin, it's good for stocks, good for everything, essentially, in terms of price action. Now, it's bad for everything else in society ever, because people suffer. Inflation gets high. We all know the implications of that. We've learned that, the hard way in the last 12 months. But, for assets themselves, it's pretty good. Now, what I will say, and this is something, because, you asked a lot of questions there as well about Australia. Australia's pivoting. It's reducing the magnitude of the rate hikes. Same thing's going to be happening in the US. We can look at the data for the US, for example. 50 basis point hike is currently at 30%, 35%. In fact, yesterday it was at 49%. It's moving around quite a bit. The point is, there is a decent probability of a 50 basis point hike in the US. And can't remember what your last question was, but I would like to say pretty quickly, yes, macro does have a lot of effect on price action. But I do want to remind you guys, right? Just because this stuff is happening, it doesn't mean that we have to go up. And all we need for that really is to understand what's been happening with Bitcoin in the last year or so, right? This is pretty important, and this is to do with the S&P 500 in relation to Bitcoin, and obviously the macro in relation to both of those things. Bitcoin topped out in November, right? The S&P 500, the Nasdaq, the Dow Jones, they topped out in January. By the time they topped out, Bitcoin was already down 40%. There's no, Bitcoin could bottom out a lot earlier. Bitcoin could bottom out a lot later. It could be up 40%. It could be down 40% by the time they bottom out. It's not perfect. It's a rough correlation. And another, piece of evidence for that is really what happened in regards to DXY and the S&P recently. For example, the DXY in June was down here at 101. But it went up massively, which should actually be bearish on paper. But Bitcoin hasn't gone down below the June low. Bitcoin was still hovering above it. So, it's not a direct correlation. You're going to get into it and answer the actual question itself. But I do want to really clarify that it's not it's not like a sure thing just because rates are going down in magnitude, whatever, that Bitcoin's going to pump. Now, it probably will, and it probably will over a longer period of time. But if you're talking about in like a specific period of time and specific price points, it's like, well, it doesn't really work like that. That's what I'd say.
Yeah, well, I agree. I'm going to expand on it a bit because I guess the whole reason we care about this in crypto, and I think that's what we need to identify, the whole reason any of us are talking about this in general is because it does have a direct influence on the state of the economy. And of course, the state of the economy influences how much people invest in risk assets. And therefore, we make money. That's why people care. So first we need to understand what quantitative easing is and why it's important and how it's going to influence. Because we've talked a lot about, if you've been watching my channel for the last year, we've been talking about this particular flowchart since November last year. But quantitative easing, like Will said, is printing money. But the purpose of that is to reduce interest rates. The whole purpose of quantitative easing is to reduce interest rates. So to understand why this matters, we need to first understand this flow chart, and then we can reverse it. So for the last last year or a month or whatever, last couple months, inflation has been rapidly increasing, right? And obviously that's been because money has been printed at a phenomenal rate post-COVID, all the relief packages and a whole range of other things. Money has been printing basically at a phenomenal rate. And we've seen those charts with the money to money supply just absolutely going through the moon like an absolute shitcoin going 100x. But we've seen inflation rise, and no one's been immune to that. But as a result of inflation rising, interest rates rise. Okay, interest rates rise, and they use rising interest rates to combat inflation. So as interest rates rise, we have another impact. We have this snowball effect. I like to think about it two blocks. We have this correlation here, which is inflation and interest rates. And then we have this extended correlation between interest rates and everything else. So as interest rates rise, interest on debt rises. Okay, lower household available cash flow. So people have lower cash as they're paying more money towards their dollar obligations. And they'll also have lower cash because they're paying more money towards costs of goods and services, meaning food, groceries, maybe services. If you've got like a personal trainer, maybe they've increased their fees, or you go to a doctor or whatever, fees have increased in costs of goods and services. Now, to account for the lower available cash flow and the increase in cost, retail, they generally sell assets. So they're looking to offload assets, risk assets that are significantly underperforming or decreasing in value, or they're not going to be investing in these assets during a time of economic hardship. So we see a double-ended sword, essentially. We see assets decrease because no one's investing, and we see assets decrease because people are selling. Now, on the flip side, companies, they have been taking massive amounts of debt on during this low interest rate period. Prior to inflation, prior to the interest rates rising, interest rates were very, very low for many years. We're looking at like 0.5%, 0%. Companies took a lot of debt on to acquire assets, and they bought a lot of assets, whether it be, financial assets, whether it be real estate, whatever kind of assets they were buying, they were loading up on assets. And we saw that because companies' stock prices went through the moon in the last 20 years. And they did that to increase their cash flows. Because if we go ahead and evaluate company stock value, we use future cash flow earnings as a basis to evaluate what the company's stocks are actually worth. So as companies acquired more debt, they had assets or income producing assets which would increase their future cash flows, and therefore their stock price would increase. So that's the correlation between all that. So what's happening now is the whole thing is reversing or could be reversing depending on what happens with the pivots, okay? So for example, I do believe we are pivoting, but if we do pivot and interest rates start decreasing, what happens to this? It flips. It flips on its head. If interest rates start decreasing, interest on debt starts decreasing, okay? Available household cash flow increases. They have more money to spend on assets. They're more likely to buy assets. Costs of goods start decreasing, okay, which exacerbates that fact. Companies start acquiring assets, okay? Cash flows start increasing, and the value of company stocks start rising, okay? all while interest rates rising will start decreasing inflation. So it's going to work in that kind of relation there. Okay, so that's kind of to explain your questions in a little bit more detail. Bank of England, we've talked about. RBA, we've talked about. Pivot, we've talked about, and we explained those in a lot more detail. There, Wolf, does that make sense to a standard viewer? Would you be able to make sense of that? Perfect.
Yeah. And I'd like to just clarify one more thing. You know, the biggest reason people have for calling for sub-K Bitcoin right now is the vague description of the macro as bad. Firstly, the macro, yes, it's bad as of current, but as you would all know by now, the market predicts the future. It doesn't reflect the present. The macro doesn't look as bad as it is now in the future. Therefore, the markets will likely rise. However, that is not a call for an immediate rise in the markets. The macro, quote unquote, the macro isn't a good reason for any short-term price action ever. It is a good reason for medium to long-term price action.
Correct.
So, you know, saying, oh, the macro, we're not going to go to 17.6K again. It's like, well, no, that's not really how it works. You could say the macro and we're not going to 10K again. It's a longer term thing. It's a medium term thing, right? And we've seen that reflect in the charts multiple times. I'm
actually trying to find a chart to explain what you're kind of talking about there, because there is actually a chart. And a lot of my followers would know I've talked about 100 times. Here it is. You can see it on screen. A lot of my followers have seen this chart many, many times, but maybe some of your followers haven't. And what this chart actually shows us...
Sorry,
I can't see. Yeah, sorry, Wolf, you won't be able to see this, but it's screen recording, so everyone can see this. But
okay.
Unfortunately, I can't share screen this one, but it's on the screen. But what this chart shows is it shows a correlation between crypto and stocks. I'll go ahead and use my cursor. You see crypto over here, stocks over here, and systematic risk, or systemic risk, whatever you want to pronounce it as. And systemic risk is essentially the risk factors in a market that alters the risk of your investment that you cannot control, whether it be inflation, interest rates, monetary policies, taxation policies, the things that you can't control. Now, when interest rates rise, systemic risk massively increases. That doesn't mean the return on the investment decreases. It means the possible risk on the investment massively increases. And when the risk on the investment increases, the risk reward ratio shifts unfavorable and people start selling. So we can use that chart to explain that. So what we're seeing now is interest rates potentially starting to decrease. What does that tell us? Well, it tells us that there's obviously a possibility that inflation's topped. It also tells us that systematic risk could potentially be reverting. But more importantly, markets move. And this is what I'm going to talk about, how I'm going to link it up to Wolf's point. If we take systematic risk and we just defined it, we split it off into two categories. We have actual systematic risk, which is the actual risk in the market. And then we have perceived systematic risk, which is the perceived systematic risk in a market, what people think is going to happen. If we look at how markets historically move, they actually move initially based on perceived risk. So when people perceive interest rates to drop, or they perceive the Fed to pivot, we don't actually account actual systematic risk for that initial move. We actually see perceived risk, systematic risk take that market forward on that move, if it's a bullish piece of information or a bearish piece of information. So when we're looking at June being the bottom, or we hear people say the economy is still really, really bad, we're going to go lower, you have to understand that markets don't work like that. Particularly financial markets, they will move upwards before the market and the economy reverses. The only indication we need for the market to bottom and indicate a move upwards isn't the fact the economy is topped out or bottomed out, whatever. Isn't the fact that we're reversing. It's we just need to have the possibility that we will reverse in the future. Just the possibility that interest rates will start to decrease. Just the possibility that inflation will decrease and the markets will start reversing. And this is what I've been 100%. Saying ever since June. And this is why I've been bullish. I've said the bottom's in since June, because I understand how this works in the market. We don't actually need to see the economy bottom out before risk assets start moving upwards again. We just need to have people say, okay, in 5 months' time, interest rates are going to drop. Or in 4 months' time, interest rates are going to drop. And straight away, that risk return on the investments in the market shift. And when it shifts positive, systematic risk decreases, return on the investment and risk reward ratios increase, the markets start recovering. So that's very, very simple. I can't explain it more simply. I'm sorry if you don't understand it. Go ahead and try watch some of my old videos and I go into a little bit more detail, but to explain that in 5 minutes is very difficult.
It's just a simple buy the rumor, it's a simple price in. Why do you think Ethereum went up before the merge, right? The merge hadn't happened yet. The point is there was news about the merge. Everyone's getting hyped about the merge. It was anticipating the future. So it's very simple market. What would you call it? I don't know. Fundamentals of how markets move. It's very simple stuff. Yeah, I completely agree. But Whale, I do want to get you to pause this so we can restart the call.
Okay, let's get into the next question. We have a question that goes as follows. What confluence do you look for to enter a trade when the price breaks out from a pennant, wedge, triangle market structure? And how do you set your stop losses? Okay, so this question is not a question we can answer today. It is way, way, way too long. I could literally write a book to answer this question.
We literally wrote a book almost.
Yeah, so the trading course is the best bet. Now we have the trading course, and Wolf, I guess you can jump in and talk about that. At the end of the video, we'll talk about that. But if you want specific and detailed answers on all of that, it's all in the trading course. I can't answer that in today's video. It would genuinely take too long. Now, if you don't want to use the trading course, the best bet would, obviously in my videos, I do a lot of short-term analysis, I do a lot of price predictions, I do a lot of technical analysis on the short term. I talk about a lot of wedges and pennants and triangles. Your best bet would to go watch my videos, stay in tune with the videos there. Or I know you're in the VIP channel, so you can see my charts and just analyze what is happening there, and just listen to what we say, because we talk about a lot of this already. It's just not specifically answered directly, but it's all talked about already. So if you just pay attention to our content, watch our videos, this will be answered. I'm going to quickly go ahead and answer it real quickly, just to make sure you understand that there's never a guarantee. So first we need to understand that everything is a risk. There's no guarantee or no specific set of rules we look for when we're looking for breakouts. There are things that can indicate a greater probability of continuation, but there's nothing that's going to 100% guarantee the price moves upwards. So even when we have confluence, even when we have confirmation by trading indicators, it doesn't mean it's always going to move upwards. Because as we know, pennants develop into wedges, wedges develop into triangles, triangles develop into pennants. We have market patterns forming around market patterns, and they generally develop into other market patterns. So you need a degree of foresight first and foremost before I say anything when you're actually trading. You need a degree of foresight. You need to be able to predict not only where the price is going to go next, but how the price is going to move between zones and how the price is going to develop market structures. And that's very important, and that is why we always emphasize, and what I did at the start of the video, I showed you those horizontal levels, because to understand how price moves between zones is the first step in trading. But what do I use? I use momentum. Wolf, I think, uses something else. I don't know. I'll have to get Wolf's opinion. I personally use momentum. The RSI is my go-to when it comes to getting points of confirmation, particularly when breakouts. I look for both breakouts on RSI as well as momentum shifts on RSI, and in conjunction with those diagonal or horizontal trendline breaks on the price action. That is what I can give you. Stop losses are usually set below the previous lows. Wolf, anything to add?
Well, look, obviously RSI is a very good one. If you're getting an RSI breakout at the same time you're getting a triangle breakout, for example, that's extra confirmation that, for example, the triangle is actually valid in itself, and it's extra confirmation you're going to move upwards. Another thing you can use is volume. Another thing you should be making and seeing the volume trends more specifically. If volume, for example, you're getting a breakout of the an ascending triangle formation, you're seeing volume trend upwards, that's indicative of the fact that strength is increasing and the move will likely continue. Another thing you can look at, and this is very important, and this goes for all trades and not only just breakouts, please cross-check with Bitcoin. If Bitcoin's rejecting from a 12-month long resistance and you're looking at entering an ascending triangle formation on the 15-minute chart on a random altcoin, you need to do a little bit of cross-checking there. Bitcoin's very important. Bitcoin controls the market. Always cross-check with Bitcoin.
Correct. I think I had something else to say, but I can't quite remember what it was. I think we'll just leave it there then. Okay, let's move up. If I remember what I was going to say, I'll come back to it. So next question. Mega Whale, you believe the bottom is more likely in June. Wolf thinks the bottom is before December, so Q4. Can you guys talk more about these similarities and possible differences in your analysis? So this is something that's a lot of people because a lot of people know myself as a person who predicted June, Wolf person predicted Q4. And we've obviously been on the same page ever since November when we called the top. We were on exactly the same page. So when we kind of branched off a little bit, a lot of people thought we were kind of different in our analysis. The fact actually is our analysis was more or less the same. The difference in our analysis doesn't come from our analysis. It comes from the weighted probability we put on certain data points. For example, I put a greater emphasis on the fact that I believe that 9-year trend line would facilitate the bottom, which at the current moment it has facilitated the bottom. That bottom is still within the 9-year trend line, on the 9-year trend line. Wolf put a greater emphasis or probability on the fact that the 4-year cycle will remain. So it's not that our analysis is different, it's just what we subjectively have opinions on in terms of data and probability. And that's the best way to answer your question. If you forward wind to the present time right now, the price actually doesn't matter because Wolf believes that 17.6, whatever it was, is the bottom, where I believe the bottom was. So it's more or less not the analysis, it's more or less the actual data points and the probability we attach to those data points that altered kind of our stance at any given particular time. I think I summed that up perfectly, Wolf. Did I sum that up well for you?
Yeah, that's pretty well. That's pretty well summed up.
Yeah. So I think we go into the 4-year cycle in the next question. I'll talk about the 4-year cycle. I'll talk, I guess, why I personally didn't go with that 4-year cycle, why I went for the 9-year trend line. We'll talk about that in the next question. And I will talk about our differences and similarities. But I think the similarities that we discussed are very much the same. The only difference it's really hard for me to say differences because I'm not Wolf. Like, at the end of the day, I don't have his brain. I don't know everything he thinks about. We share analysis closely. I would say the differences in my own analysis compared to other people's analysis, I can say that for a fact, is I took first off, it was more risky to predict the bottom at 17.6K with the economy how it's looking. But since I have backgrounds in economic and finance and accounting, I have a bit of a deeper understanding of how particularly the economy works. And I foresaw a lot of this pivoting and foresaw a lot of this decrease in interest rates and all this kind of stuff well before it happened, just as I foresaw it well before it happened at the top. So I use that information as kind of confluence and data to help reinforce my stance at the bottom. I also use that 9-year trend line to gain support if support until it is lost. I believe that was a very valid point of indication, as well as all the numerous amount of technical indicators that were suggesting the bottom was in. And now this is the thing. A lot of people are saying we're going to 10K, we're going to 9K, we're going to 3K. Everyone who was saying that in June was looking at lagging indicators and expecting the lagging indicator trend to continue. What they don't understand is lagging indicators, or indicators in general, not only after massive periods of volatility, are basically useless, but when it comes to predicting points on the macro chart where trend reversals occur, they're completely useless. If you want to predict macro reversals on a chart, or just reversals in general, do not use lagging indicators. Do not use indicators. Indicators use are not for reversals. Indicator use is for predicting trend strength. That is it, okay? The reversals occur before the trend looks strong. Therefore, the indicators will never be able to predict bottoms or tops because they're actually showing us the strength of the trend. So if you're waiting for the indicators to turn bullish, you're going to miss the bottom. If you're waiting for the indicators to turn bearish, you're going to miss the top. That's exactly why people at the top said, oh, we're going to 300K, because at the top, the indicators were looking freaking bullish, guys. They were looking stupid bullish. But at the top, I was like, no, we're going down, because I understand, and Wolf said too, he understands. We understand that when we're predicting macro trends, you have to use ratios and you have to use market structures. That is it, simple as that. And my analysis differs from everyone else. Obviously, me and Wolf analysis differs from everyone else because we understand the depth of the market in the terms of the economy. More importantly, understand when and when not to use indicators, and we understand indicators in a great enough depth to know their limitations and drawbacks. There is no one particular indicator on this planet that will turn you into a profitable trader.
Yeah.
You have to understand how to use your indicator. And a lot of people ask me this question. Wolf, a lot of people ask you this question too. What indicators do you guys use? What indicator do you use to do this? And it drives me insane because you have to find something that works for you. And it really do have to find something that works for you. For me, I use the RSI. The RSI is the indicator I use. I've been using this my entire trading career. I mastered the RSI. I know how to use it in every scenario. You have to find an indicator that you understand, that you can work with, that helps you. And one indicator works for one person, it might not work for the next person. Just because you take a hammer and you try and nail a nail into a wall and it doesn't go in, it doesn't mean the hammer's broken. It means you're doing it wrong. And that's very important to understand. People say technical indicators don't work, or this indicator is not working. No, the indicator works, you're just using it wrong, or you're using it for the wrong purpose. And it's very important to understand. Understand what your indicator is, understand the limitations and drawdowns of the indicator, understand what the indicator actually can tell you, understand how to derive and extract information from the indicator, and then how to apply that information and then make decisions based on that information on the charts. That is how you use an indicator. No indicator is going to tell you enter now, exit now. It doesn't work like that. All right, so I just got a little bit heated, but that's basically what I wanted to say.
No, it's fair enough. And if they do tell you that, if they do tell you when to buy or when to sell exactly, they're likely not a very useful indicator. Otherwise, everyone would be a millionaire.
They're lagging. So, they're lagging. Yeah. And this is, I'm just gonna bridge off because I'm gonna on a bit of a rampage up here. But I see a lot of YouTube videos of 500,000 views, like 1 million views. Like, this indicator has an 80% success rate, mate. The indicator has an 80% success rate back testing. But if you're back testing a lagging indicator, it's always going to have a high success rate because it's a lagging indicator. Because the indicators morph around the price action. Simple as that. You have to forward test your strategies. The only way to find out if your indicators or your strategies are working is to use them consistently over and over and over again and forward test them. And guess what? Statistically, most indicators and most strategies are not profitable. They're not profitable because the way to trade is not to use a singular mechanical strategy. You have to understand everything. You have to understand how the price moves. You have to understand how supports and resistance are tested. You have to infer a lot of information and use a lot of foresight on the price action in the current moment to make your analysis, and the way you analyze and the way you trade it will change every single time. There are definitely areas and periods of price action that are similar, such as market structures. We have similar price action in structures such as wedges and pennants. And that's why we help you guys identify and understand these in the course, because these are points on the chart that provide similarity. And when we have similarity, we have pattern. When we have pattern, we have greater probability of moves in the same direction as we've seen before. But anyway, that's enough about that. Moving on. Hey Whale, we know Wolf's thoughts on the 4-year cycle, but what are yours? Are they similar? Yes or no? I'm going to say yes because I believe in a 4-year cycle. I'm going to say no because the only difference, I think the top was actually not in November for a 4-year cycle. I believe the price top was November, but I don't believe the 4-year cycle top was November. I believe that was back in May or April, whatever it was. And that's the only difference. Now, I don't think it's going to change much. At the end of the day, I just go off the market structure. At the end of the day, like me and Wolf have already said, the only reason why we do these macro analyses and stuff in terms of price action is for you guys. We don't really care. I personally never trade the larger time frame anyway. I personally trade like the 1 minute and 5 minute chart, sometimes like the hour chart and like a day chart. But I'm a scalp trader, so I don't really care. So I can answer a question, but at the same time, I don't think my opinion is very valid or my opinion matters too much, because even to myself, my opinion doesn't matter much on that. So I think I'm going to steer away from giving a specific answer on that. My only answer I'll say is I do believe the 4-year cycle exists. You'd be stupid to ignore the fact that it does exist. It absolutely does exist. If I had to go ahead and chart it up and do my ratio analysis, I'd probably start by looking at a top in April, or whatever it was, April, May, or I can't remember exactly what it was, instead of November. But at the same time, the November ones look pretty good so far, so who knows. That's my answer. Yeah, look, I mean, it's I'll share my screen briefly and just show you guys what it is, because I know some of Wales viewers might not be familiar with the chart, but my viewers certainly are. Yeah, this is the 4-year cycle chart. I won't get into it too much. Based on the halving started in 2012, it's essentially a date range trend that, by the way, I just want to say, I haven't really seen anyone properly draw out the chart in the same way that I've drawn it. I've seen people speak about the 4-year cycle a bunch and point about, like, every 4 years we see this, every 4 years we see that, but no one's really gone ahead and like done the date range trend fully. At least I haven't seen it. So I think I'm one of the only people to have this chart. Not to say it's a complicated chart. It's just interesting to me because there's nothing invalid about it. So you'd think people would have it, but hey, look, essentially by the predictions this chart has, by the trend that this chart has, it does suggest we'll bottom out in Q4. We are in Q4 right now, and I suppose the big question is, well,
you know, I suppose the question is, will we go down and actually see an actual bottom in Q4? Because right now the bottom's in June. So yeah, we've seen a double bottom, and technically the right-hand side of a double bottom has been Q4, but the actual price bottom itself hasn't been Q4. So that's interesting. I guess we'll see. There's nothing really confirmed yet. Nothing's really confirmed at all. In fact, we just need to wait and see. In fact, I would argue that we'll probably be seeing very, very, very shortly, as per this downtrending line. You know, if we just disregard the fact that this breakout's happened, because it's not confirmed yet, in my opinion, you know, we will be seeing a decision that will be forced to be made. As you can see, this yellow line is compressing against 17.5k. That decision will be forced within the next 2 weeks. So we'll probably find out within the next 2 weeks whether the 4-year cycle needs to be altered or what would happen with it. I think I need to do a lot more analysis to understand exactly, you know, sorry, my throat, exactly what the implications of us breaking upwards here would be. But as of right now, it's still valid, so I'm still sticking by it. But yeah, that's the 4-year cycle chart for people who don't have it. Go ahead and, you know, if you're interested, screenshot it, chart it up. Yeah.
Yeah, and I'll just like let you keep that screen up for a sec. But I think it's also kind of important to understand is that even if like the 4-year cycle chart over here doesn't predict that exact bottom, or it doesn't go all the way down to that target, it doesn't invalidate the chart by any means. Like, look at the drawdown we've had on that from that chart, from that top. So this is what people need to understand. It's like, just because we haven't hit that target by the dollar, it doesn't mean it didn't do its job. Because even if it bottoms here, which I believe it has, and it continues upwards from here, and didn't quite go down 12k, it doesn't invalidate the 4-year cycle. It just changes that ratio, and then you apply that ratio difference to the next time, and so on and so forth. So I think that's quite important to say as well.
Yeah,
that
just clarifying as well. I know you know this. It was probably just a mistake there, but the 4-year cycle, the way I've drawn it at least, doesn't predict price points, it predicts dates. So I'm looking at Q4, not specifically 12k. That's just a random.
No, for sure. That's what I'm saying by I was saying by ratio, because I see you have that 12k there. So I'm just clarifying that for the viewers, that it's not necessarily saying that we're going to 12k. It's more about the ratio. Yeah. It's more about the ratio. Yeah. Yeah, so it doesn't have to specifically pinpoint that exact dollar, like I said. It's more about that ratio analysis from the top. It's still been very effective, even if it doesn't go down to 12k. The reality is it's still been very effective at predicting the bottom.
Correct. Yeah.
I think that's it. That's all we want to talk about. Did you have any questions from your channel that you wanted to bring up? Any benefit? Or did we kind of answer the good ones?
I think all the questions are kind of similar. I think we've answered most of them. Yeah.
Cool. I think that's it. I don't think there's anything else I want to talk about.
If that's it, we'll jump into quickly our course. So we have a course here. I'm sharing the screen currently. Let me refresh this website. It doesn't seem to be loading correctly, but there it is. Become a Trader 10-unit course. If you're interested in learning how to trade, this is obviously, if you watch our videos, you see how we do analysis, you want to do what we do, whatever. You want to enter trades, you want to make money in crypto, or stocks or anything Forex. It kind of applies universally to a certain extent, but definitely about crypto. You can check out the course, go to the website. It'll be in both of our pinned comments and descriptions. It's cryptoacademy.courses. That's the website URL, and you can read about it here in the blurb. Essentially, it's 10 units. Goes from kind of the fundamentals of crypto all the way through to very advanced TA and how to actually find trades and how to manage risks, etc. You know, no doubt we've got, what have we got now? 74 students, I think. Yeah, 74 students. No doubt this is probably, I mean, look, this is definitely a biased opinion, but I'm trying to be as unbiased as possible. We've done an extensive market research on what courses are available in the crypto market. We've done extensive research on what they entail, whether they have worksheets, whether they have quizzes, whether they have slides, videos, whatever. I can tell you right now, there is no course that I have found that is more extensive for this price point, and especially and for this quality of data. We've got two separate analysts, myself and Whale, who've gone through this course step by step, analyzing each of the things, putting our own little personal twists on it, and also remaining true to the objective data. And we've created, I think, one of the masterpieces of the course world. So go ahead and check it out. I know that's definitely a biased opinion, but hey, look, you can take my word for it if you want to.
I think I'll just jump in real quick, Wolf. I'll just jump in real quick.
Yeah.
And I think what differentiates our course from any other course on the market is our course gives you guys, or teaches you guys, the building blocks, the foundations you need, the actual solid information you need to actually become a profitable trader. We teach you the basic building blocks you need to build up from there and become profitable. A lot of other courses just tell you strategies and teach you this and teach you that, but you don't understand how to use it. You don't understand what it means. You don't understand why. We go through why, we tell you the how, we show you examples, we really teach you from the ground up. And that's why not only, you know, you're going to learn a lot, but at the end of the course, you're going to come away with a completely altered mindset and a whole range of, whole repertoire of different skills when it comes to actually analyzing and trading, because before you can trade successfully, you have to master analysis. Before you can trade successfully, you have to master analysis. I know I repeat myself, but I think it's worthy of repetition. And Wolf, I'll hand it back to you.
Yeah, and look, there's no guarantee as well. I would just like to add, I'm not trying to make you guys scared, but there's no guarantee we're going to keep this course at the price we have now. So, you know, we can raise this course price anytime we want to, and we probably will as interest comes back into the cryptocurrency market, because we understand the value of this course. You know, for full disclosure, I'm not going to tell you what the price is. You can email us and find it out for yourself. But this course is 10 times cheaper than the likes of the big names. I'm not going to name them, but you guys probably know who I'm talking about, who sell courses in the crypto space. People with hundreds of thousands of subscribers. Sorry, my throat. 10 times cheaper, 5 to 10 times cheaper. So, you know, you have to really consider whether, you know, what you want from the market here. If you want to take trading seriously and you're trying to learn TA via websites and YouTube videos, and yeah, you can do that, but understand it's going to take you 3 times as long. By the time you learn, you're going to miss out on half the price action that's going to make you money, and it's going to be 10 times more unreliable. So it's really up to you guys what you guys want from the market and whether you guys want to take it seriously or not. Look, you're welcome to keep enjoying the free content. There's no obligation to pay for anything, but I would encourage you to at least check it out, at least chuck us an email so you can make an informed decision. And then as well, I would like to encourage you guys as well, if you want to support the channels, you know, you can go to whether you're watching my video or Megawell's video here, whatever, which one you want to support. Go ahead and sign up to BitGet, the exchange, using our referral links. Again, they'll be in the pinned comment or the description. Those are both, you know, for both of us here, and this is from professional traders, we both use those platforms, and we actually reached out to BitGet for those partnerships. So BitGet didn't come to us and say, hey, please sponsor our exchange. We used that exchange. We understood, hey, this exchange is really good. This exchange is much better than Binance, much better than Coinbase. We used that exchange and we actually reached out to them. So that should, you know, in itself prove the validity of our claims there. So go ahead and sign up with our referral links there. But I think that's about it, unless you have anything to add.
Yeah, I'll just like to say, I hope everyone enjoyed the video. Obviously, we usually do this fortnightly, so we'll be back next fortnight in 2 weeks to do another video, and we'll see you then.
Yep, see you guys.